two kinds of education credits. We've got the American Opportunity Credit, and we've got the Lifetime Learning Credit. AOTC, American Opportunity Credit. The T stands for tax. And then LLC, Lifetime Learning Credit. This is for these credits, now not to be confused with student loan interest, because student loan interest is something that you're paying separate from tuition. I mean, your tuition was probably a part of it, and chances are you're paying it after you've left school. This is for actual tuition, right? So these two types of credits, the American Opportunity Credit is a more valuable credit than the Lifetime Learning Credit. But as you can imagine, with a more valuable credit, you have more restrictions on who can use it and what it can be used, what types of expenses qualify individuals for that American Opportunity Credit. So qualifying expenses in general are amounts paid for tuition, fees, and other related expenses to an eligible education institution while taxpayers or their spouses are pursuing undergraduate, graduate, or vocational degrees. You guys all are pursuing a qualified degree. Qualified tuition and related expenses include amounts paid for course materials such as books and supplies. Qualifying expenses do not include room and board or student activity fees. That is not included. So they must be for an academic period that begins in the same tax year as the year that the payment was made, or that begins in the first 3 months of the following year. So that allows for paying in December for spring semester, or November, whatever you're paying for it. What is an eligible educational institution? Post-secondary educational institution, college, post-secondary, so high school doesn't count. Eligible to participate in the student aid program. So any school where you could get a student loan would qualify. And that would be most educational institutions, although there are some that don't qualify. So December 2022, Fred pays his son's college tuition for spring semester. Semester starts in February. He can deduct the expenses that he paid in 2022 because that semester started within 3 months of the payment of the beginning of the year. Payments used using borrowed funds still qualify. So if you borrow, take out a student loan, say you get $10,000 of student loans, you take those funds and you pay the educational institution for the tuition and fees, that qualifies, even though that's not your money yet, right? Even though you owe that money, you're gonna owe that money back. That still qualifies for the credit. Now, when it comes time to pay that loan back, you still get to take the student loan interest, the interest that you pay on that loan, you still get that as a deduction. So if a student receives a scholarship or other income that's excluded from gross income, that excludable income reduces qualifying expenses. So if you get a scholarship, so you got $10,000, let's say your tuition was $12,000, you got a scholarship, you paid $10,000 toward that, and you got a $2,000 scholarship. So the $2,000 doesn't include, even though that was the tuition and fees, you didn't pay it, right? That was a scholarship. So you have to reduce it by those qualifying expenses. Not by, you don't have to reduce the amount you paid, but you have to reduce the qualifying expenses by that. If a dependent pays for qualified expenses, those expenses are deemed paid by the taxpayer. That means that if you're still a dependent on your parents' tax return, even if you paid for the school, your parents get the credit. Your parents can claim the credit because you're still a dependent on their tax return. If someone other than the taxpayer, spouse, or dependent pays the expenses directly to the educational institution on behalf of the student, the expenses are deemed paid by the student. So if Uncle Rich Man pays your college tuition and pays it directly to the school, not to you, but directly to the school, then you get to claim that credit, okay? This is the Schedule R for the credit for the elderly and disabled. Okay.
Wait.
Yeah.
Student loans.
Mm-hmm.
Their credit?
No. So the student loans are the interest. The amount of interest that you pay up to that $2,500 is an adjustment on your tax return. So it's a type of deduction. So reduce your taxable income up to $2,500 if you qualify for it. This is when you actually pay the tuition and fees. Okay? Mm-hmm.
Like out of pocket?
Is that, I'm sorry?
Like out of pocket?
Yeah. Well, even if you take a loan for it and you pay it, you still get this.
Oh, okay.
Yep. Yep. Even if you borrow it for it. Okay, so this is the difference between these two loans. They also call this the Hope Credit. I don't know if they call it that much anymore. It used to be called the Hope Credit. So the American Opportunity Credit, eligible students can take up to $2,500 credit. So dollar for dollar reduction in tax liability of up to $2,500. You can only take it for the first 4 years of your post-secondary education. That means your bachelor's degree, right? Can't use it for graduate degrees. Can't use it after, you can only take it for 4 years. So if you're one of those people that takes 8 years to get your bachelor's degree, you're only gonna get to take it for 4 years. Because then you've taken it too many years. Is that, do you have a question?
No, I was.
Oh, okay, okay. Up to 40% of the credit could be refundable based on income. Now remember, we've got refundable credits and non-refundable credits. So most of the credit is gonna be non-refundable, but there is a portion of it, 40%, which is $1,000 that could be refundable. Now, the student has to be pursuing an undergraduate degree or other recognized education credential as long as it's you're in the first 4 years and it's under that graduate level. They have to be enrolled at least half-time for at least one academic period beginning during the year. So, if you're enrolled half-time during the spring semester, but you're not enrolled in the fall semester, that's okay. You can still take that credit, the American Opportunity Credit, if you otherwise qualify for it during the year. Okay? Qualified tuition and related expenses include books and supplies, whether or not the materials are bought at the educational institution as a condition of enrollment or attendance. So that means that, so when you signed up for this class, your book was included, right? You paid that was included, and you had to buy it, right? It was part of it. So even if it wasn't required, if you went to the textbook outlet and bought a book, for the purposes of the American Opportunity Credit, that still counts. You'll see that for the Lifetime Learning Credit, that does not count. That's one of the differences there. So books and supplies. It also includes like laptop computers, supplies like that, things that, paper, pencils. Do people still have those, paper and pencils? Accountants do. We're probably one of the few fields that actually still has it. Also, you cannot have a felony drug conviction on your record. That's one of the restrictions. You're laughing, but that is a consideration. You cannot it has to be a felony, and it's only a drug. You can murder as many people as you want and still take it and still claim the credit, but you cannot have a felony drug conviction on your record. And it's a conviction. You can be accused as long as you weren't convicted. That's the American Opportunity Tax Credit. I'll go through the calculation here for it as well. Lifetime Learning Credit. This is up to a $2,000 credit per taxpayer. Now, this one is per eligible student. That means if you're a parent and you've got 3 kids in school, you can take up to $2,500 credit for each of those kids, $7,500. You've got 4 kids in school, about $10,000. So this is per each eligible student. This one is per taxpayer. So per tax return on this one. So this one's more limiting. Up to $2,000 credit per taxpayer. So this one though, you can claim it for undergraduate, graduate, postgraduate, whatever, all of that. You don't have to be degree seeking either. You can just take a class here and there. You can claim this credit. Available for all years of post-secondary education and for courses to acquire or improve job skills. This one is not refundable. None of it is refundable. So it can't bring you below 0. Don't need to be pursuing a degree or any particular recognized educational credential. You want to take a culinary class at DMAC because you want to learn how to make desserts. Take that class and you can claim the credit as long as you otherwise qualify for it. It's available for 1 or more courses. Remember, this one you had to be enrolled at least half-time for at least 1 academic period during the year. This one doesn't matter. Qualified tuition and related expenses include course-related books and supplies, but only if the amount was required to be paid to the institution as part of the enrollment and attendance. So like these books that were included in your tuition, for those that would qualify for the lifetime learning credit, that would be okay. But if those books were purchased elsewhere, they would not count as expenses for the lifetime learning credit.
And that one's limited to, was it 2,000? So even if like you pay more than 2,000, the max you can take is 2,000?
So the credit amount is limited to 2,000, but you'll see it's 20% of the expenses. So up to $10,000 of expenses essentially per year.
Oh, okay.
Yeah, but the actual amount, so this is the amount of credit that you can take toward it. You can have a felony drug conviction. So there you go. That one's not limited here. These things create awkward questions though. When you're a tax preparer and you've got to ask these questions of clients, right? Okay, well, do you have any felony drug convictions? And they're like, what? Well, why are you asking me this?
And then to tell them if they say yes, like, oh, never mind.
Yeah, exactly. Like, I'm sorry, you don't qualify for it. That's right. And then they'll go to somebody who'll take it for them anyway. Okay, so here we've got Aunt Juanita pays college tuition for her nephew, Fennell. For purposes of the education credits, the expenses are deemed paid by Fennell. If Fennell is a dependent of his parents, though, his parents can take the credit. In that case, even though the aunt paid for it, because he's a dependent, the parents get to take it. All right. So, American Opportunity Tax Credit. 100% of the first $2,000. 25% of the next $2,000. That's the amount of the credit. So, if you think about it, so 2,000 times 100% is, anyone? 2,000. Next 2,000 times 25% is 500. Next 2,500. So this one's dollar for dollar. This one is 25% of the next $2,000, but for the maximum of 2,500 per student per year. So a student has to be carrying at least half of the normal course load. I think we did this. Enrolled in it. Yeah, we talked about this. Up to 40% of that, so $1,000, may be a refundable credit. They have to meet certain income guidelines for that. Taxpayers may receive a refund even if they owe no taxes. None of the credit is refundable if the taxpayer claiming the credit is a child under the age of 18 or a student who is at least 18 and under 24 whose earned income is less than 1/2 of their own support, has at least one living parent and does not file a joint return. So for those younger taxpayers who aren't dependents, but they could be dependent. So this is to discourage individuals from claiming, it's to discourage students from filing their own return and not being claimed as a dependent solely to get the refundable portion of this credit, okay? Then they're not eligible if they do that. Does that make sense? Right, again, it's to, any of the complications are to discourage fraud, okay, for the most part. So, we've got Lauren and Ed, they paid $3,600 of qualified tuition and related expenses for their daughter. She's in her 4th year of college, so she qualifies for, she's got no, we'll assume she's got no felony drug convictions that her parents know about. So $3,600 of qualified tuition, so the first $2,000, she gets 100%. The next $2,000 is 25% of it. So $3,600, these expenses included, so it's already in there, $450 for books and supplies. So she'll take $2,000, 100% of that first $2,000. The next $1,600, she gets 25%, $2,400, or her parents do. Make sense? Okay. Lifetime learning credit. This one's fairly easy. It's just 20% of the first $10,000 of qualified and related tuition expenses paid during the year. It is determined per taxpayer, not per student. So the maximum credit on that tax return is $2,000. Here we've got Emmett and Francine. They paid qualified higher education expenses of $3,000 for their daughter, $4,000 for their son. Now, there are AGI limits, yeah.
Okay, so I just have a question, so you said that it counts per return, not per taxpayer,
Mm-hmm.
but like in one of the previous examples. that
Oh,
were
were they
going
doing
over,
it-
Like the, like child credit, you're saying like taxpayer 1 or taxpayer 2, so if it's a joint return, do they count as like the same taxpayer?
That is a good question.
Okay. Or just for
Let me,
this one, but not-
I wanna give you the right answer.
Okay.
So I think I know what the answer is, but I
Okay.
wanna give you the right answer, so
Okay.
let me look at that.
Okay.
Yeah, cause sometimes taxpayer refers to the tax return and sometimes it refers
Okay.
to just the first two names on that tax return. Dependents wouldn't be considered the taxpayer, so any dependents on the tax return wouldn't be
But
considered.
like, if it was like, say a
Right.
married couple and.
Right, and they
of
both
them-
had it, right,
yeah.
exactly. So
Okay.
let me double check on that.
Okay.
Okay, so, without regard to any AGI limitations or other credits, they can claim a lifetime learning credit of $1,400. Now, this is kind of a little preview, we've got some AGI limitations, so we have a phase out. Alright, so once we figure out how much we qualify for, then we've gotta compare it to our adjusted gross income and see whether we get all of it, none of it, or something in between. Just like we did before with that student loan, with the phase out. And we already went through all that stuff. Alright, so let's look at the phase out. American Opportunity Credit, let's see. So AGI, MAGI is modified AGI. So modified, I don't know if they give us the definition of modified here. Usually it means it's the same thing. We've got to add back like some foreign income and maybe some,
That's income ed.
is it up there?
Yeah.
Oh, yeah, foreign earned income, okay, so this one's just foreign earned income. So we have to add that back because it would have been, if it was excluded, we've got to add it back. So, and as I mentioned here, prior to 2020, so this is another one of those credits where they changed it for a couple of years because of COVID. And then it's been brought back to essentially what it was. So I don't know that we need to know. Alright, So these are the Americans, so for both of them, oh, no, actually, it used to be that they had different limits. Different phase-out limits, now they've got the same phase-out limit, which is great, it's less for us to remember, right? So, for both of these, phase-out ends at, for married taxpayers, it ends at 180,000 of modified AGI, starts at 160,000. Okay, so anything modified AGI below 160,000, you can take 100% of whatever that credit is. Above 180,000, you're not gonna get anything. You're not gonna get any credit. In between, you're gonna get part of it. Same thing, for lifetime learning or American Opportunity Credit. Single, that phase out is between, 90 and 80,000. Okay, so we'll look at, calculation here. So Quinn and Andy are married filing jointly, so we're gonna use that phase out. They have modified AGI of 164,000. Okay, so they're like $4,000 into that phase out range. Pre-limitation lifetime learning credit is $1,200. So first thing we do is figure out what that phase out range is. So 164, whoops, 180 minus 164, okay, divided by 20K. What do we get here?
For 0.80.
80%? Okay. So whatever they get, they're gonna get to take, so these are the expenses that they had, $1,200. Or this is their credit, sorry. This is the credit once they've calculated it, their lifetime learning credit. So it would have been, this is 20% of what their actual expenses would have been. They get to take 80% of that amount. So 80% times the 1,200 equals 960 credit. And that makes sense, right? So they are like 20% into that phase out range. About 20%, yeah, 4,000, that would be 20%. If they had modified adjusted gross income of 160,000 or less, they get the entire 1,200. If it was more than 80,000, 180,000 or more, they would get 0. Okay, so let's see. Let's say we got somebody. Let's go a step further. Let's say we've got. We're gonna do the American Opportunity Credit. Well, yeah. What's that? From the homework, yeah. Can you give me some?
A single individual with a modified AGI of 32,900 and expenses of 3,400 for a child who is a full-time college freshman.
Okay, so expenses, one child, freshman. Okay, so they're not gonna be in the phase out range, we know that, right? Because it's 32,900, it's below the, we'd have to be up to 80,000 before we get to that. So they're in their first year, great, so they're gonna qualify for the American Opportunity Tax Credit. First 2,000, they'll get 100%. 2,000, the next 1,400, they get 25%. So what is that, 375? What did I get?
350.
350. So 75. So 2,350. So let's say that they had. Let's say that this was 82,900. Okay, so our pre-AGI phase out is 2350. But we can't take all of this. So we've gotta take 90,000 minus 82,9 divided by 10,000. When we get there. Should be a point something. Cause it's 0.71? Okay, so they get 71% of this. Whatever that is. Okay, so first thing we have to do is figure out what the credit is, and then we look at what the limitation might be with the AGI. Okay?
For the modified adjusted gross income, how is that different than the just adjusted gross income again?
So it would be, the definition for purposes of this credit is you would add back any foreign earned income that had been excluded. There is a foreign earned income exclusion, like if you work overseas,
Okay.
you can exclude, and you meet certain requirements for the amount of time that you were gone, you can exclude certain amounts of that income that you earned. So if you got that, you'd have to add it back.
Okay, so for what we're doing for this, if there's no foreign income, the AGI is gonna be the same as the modified AGI?
Yep. Taxpayers can use qualifying expenses for the American Opportunity Tax Credit or the Lifetime Learning Credit, but not for both. So like if you had $10,000 of $10,000 of expenses, you couldn't claim the American Opportunity Credit for that first 4,000 and then use the 6,000 to then claim the Lifetime Learning Credit. You can only do one or the other for those same expenses. Taxpayer who is an eligible student or who has dependents should take the credit that yields the greater tax savings for their situation. Now, most times the American Tax Credit is gonna be the more valuable credit than the Lifetime Learning Credit. But not necessarily always, I suppose. Maybe not, I don't know. Art and Arlene paid $3,200 of qualified expenses for their dependent son Albert. He's a freshman. Their modified adjusted gross income is $73,000. They're married, filing jointly. Okay, so we don't have to reduce their credit at all. The couple could choose to either take the American Opportunity Tax Credit, which would be $2,300, or the Lifetime Learning Credit of $640. Most times that $2,300 is what they're gonna wanna take. I can't really think of a situation where you wanna take the lower credit. But you get to choose it, yeah.
And then for the first one, the American Opportunity Credit, so that one's just the first 4 years, but if they're like different kids, then they could take it for like 4 years for kid A, 4 for kid B, and so on?
Yes,
Okay.
each individual gets 4 years. Yep, so if you space your kids out enough properly, you could be taking it for years and years.
Including yourself.
And yourself, exactly. Okay.
Do they have to be consecutive, or if they take like a year off, could you do like, take it like
It doesn't have to be
year
consecutive.
1, year 2, and then they took a year off, and then you could take like the 3rd year of it?
Yeah.
Like,
Yeah, you just can't take it for more than 4 years.
okay.
And you have to still be in your first undergraduate. You have to be in undergraduate studies, so you can't be.
Like go for like a master's or
Exactly.
something? Okay.
Exactly. Let's see, so this is the form where those credits are claimed, the 8863. I'm not gonna go through all of this in detail, we're kind of running out of time here. But you'll see we've got refundable portion would be calculated up in this part. So this would only be the American Opportunity Credit, right, to calculate if any portion is refundable. And there are two different places on the 1040 where the refundable and non-refundable part go. The refundable part is gonna go down with the payments. Okay, because payments as well would take you below zero. You can result in a refund because you made payments, right? The non-refundable though, it's like a payment, but only to zero, only to a liability of zero. Non-refundable education credit, so this would be the lifetime learning or the portion of the American Opportunity Credit that's not refundable. So you'd have to go through and do a full calculation. You guys are probably familiar with this form, 1098T. This is the form that universities send out that gives the information that is used then to prepare the 8863, the tax return. So payments received for qualified tuition and related expenses are up in box 1. It used to say tuition, like it was the tuition that was charged, which was kind of useless because just because you were charged it didn't mean you paid it, right? Any scholarships or grants that were received. So if those wouldn't necessarily offset any payments, but they would offset your expenses. So for example, if you had payments, the school's not gonna list how much you paid in books, right? Unless it's unless it's included, yours probably will. So you received, they received $10,000 of payments. You had $2,000 of scholarships. The $10,000 was paid through a student loan. Maybe those $2,000 of scholarships paid for books and supplies, right? So then you could use that. Of course, you're not gonna, anything more than $10,000 really isn't gonna get you any benefit anyway, but, so maybe that example wasn't great. My numbers weren't great for using that as an example. Graduate student, check. That would mean, if that was checked, you don't get the American Opportunity Credit, right? At least half-time student, that needs to be checked for the American Opportunity Credit. Doesn't have to be checked for the Lifetime Learning Credit. So it's entirely possible as well for a student who is in their first 4 years not to qualify for the American Opportunity Tax Credit if they weren't at least a half-time student. If they had a felony conviction, you can have to use the Lifetime Learning Credit instead of that American Opportunity Tax Credit.
For the payments received there, so is that before the scholarships and grants, or is that like, so if there's
Well,
like
you're right.
12,000 due, but
You're
then
right.
you had 2,000?
This very well could, and you know what I used to do was I would ask clients to give me the printout of like their account. Because then I could see, was this a part of that? Like, are they including scholarships as a payment?
Well, DMAC usually has it filled out for you, and they email it to you, so they separate the two.
They separate the two, but like as a tax preparer, I wouldn't know if the institution is including scholarships. Like if they received $1,000 on your behalf for a scholarship, they might include that $1,000 up here. It should, and for purposes of the credit, it shouldn't be, you can't use it because it wasn't, you didn't pay it.
Right, but number 5 has they wouldn't just put it there? You don't think they?
Well, they would put it there as well. But it could be, depending upon the institution, that box 1 includes box 5, or maybe it doesn't.
For the problems, like, for the class here, do you know if box 1 includes 5 or not?
I don't know.
Okay,
I don't know.
okay.
That's why, like I said, you wanna, if you look at the printout, like the billing, then you can tell. Does it include or not? Okay? All right, so that's it for today.